Today.
Sponsored by Anthony Mendez.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez. Gordon is out today. Woohoo! So I have the show solo, so I'm counting on you folks to give us a call, 800-516-1220, 800-516-1220, with anything on your mind to do with real estate. Plenty to talk about out there. We're getting a lot of buzz about, what's going on in the Bay Area and in California. You see some numbers about, existing home sales are dropping, inventory is rising, things like that. That if that's on your mind, you're welcome to call the show, 800-516-1220. Rates, they're at a one-year low right now. Woohoo! That's great news as well, considering that affordability is the number one problem with buyers. And buyers are openly saying it's like 75% of buyers that are looking to buy a house that didn't buy a house said their number one reason is affordability. They can't find a house that's in their right price. So, and that's starting to level things out. But there's some good news behind that, and that is delinquencies are low. We're not going to get in that situation where we see that snowball effect of people dumping houses. So delinquencies are like 18-year lows right now on mortgages. And then you have, the home prices, like I said, are leveling out in the West. They're increasing a little bit faster on the East, not getting that same kind of year-over-year decrease like we saw here in the Bay Area, especially like San Jose, San Francisco saw it, Seattle. I think Portland's doing okay, but places like Reno is going up because it was a more affordable town. So we're seeing things level a little bit, and interest rates being where they are. Freddie Mac has the 30-year fixed at 4.35%. Remember, these are for what they call conforming loans in the what they call the standard conforming limits. In the Bay Area, I think it's 474, and the high balance is like 726. Anything over that's a jumbo. So with these rates where they are, and people, refinance activity, for example, spiked, at the end of January, and that's great news to see that people are saying we're seeing the opportunities to save some money, take some cash out, do something. We see a lot of people too taking cash out and buying investment properties in places like Atlanta. Atlanta is one of the hottest big cities in the United States. It's outpacing the national growth. They're up 4.8% annually to a median home price of $229. So $229, you can put $100,000 down on an investment property and rent it out, and you're cash flow positive. But you only spend $100,000, and you're in an affordable city where more people are buying homes. Millennials are looking for places that have jobs and affordable housing and affordable rents. That is why a place like Atlanta is doing well. Then you have the opposite side of that, and you have a place like Washington, D.C., where inventory is plunging because nobody wants to sell. They're waiting for home prices to go up because Amazon moved in. They're promising 25,000 jobs or something like that at high-paying jobs of over $100,000. So those are some interesting phenomenons that we're seeing that we usually would see on the West Coast, which I think a lot of people aren't used to. You'd like me to say that we're seeing double-digit year-over-year returns. Instead, I'm saying we're seeing a slowdown. Rates are going to help, but we're also seeing rents going back up. We saw rents kind of stagnate for a while, and now they're going back up again. So what's happening is that we're seeing this balanced market. We're seeing a little bit of migrations. People from New York, for example, they're all moving to Florida. People from the Bay Area, they're all moving to places like Seattle. They're pulling back a little bit, Portland's, and then places like Denver, Phoenix, Reno's, Boise's, Salt Lake City's. And we're seeing people, and Sacramento, which is the number one place for people to move, you're seeing people move to affordable communities and where there are jobs. So I think this is going to be a theme we continue to see throughout 2019 as people start going, what's going on with my taxes? I just got 8% or 9% lower in tax refund compared to the prior years. And my income's not getting any better, although nationally we are seeing incomes increase a little bit. So we're seeing this leveling off. But I think it's also an opportunity for investors. Investors are looking at places like Atlanta and other places where people are moving. Texas is a huge place where people are moving. Austin, San Antonio, the Dallas area. And I think if I didn't say Houston, again, it's all affordable and there's jobs moving there. We know that there's some big companies moving to places like Austin. And then, look what happened in New York. New York inventory is starting to skyrocket in the areas where Amazon was going to move, and now they've pulled back. So you're seeing this relationship a little bit more prominent because of how tight inventory is and how tight affordability is. So we're going to see a little bit more pronouncement in that respect. But we like these rates, 4.35% according to Freddie Mac weekly survey, the 15-year at 3.78%, and the 5-year ARM at 3.84%. That's kind of shrinking, that the difference between the ARM rate and the 30-year fixed rate. It usually was over 7.75 or 3/4% all the way up to percent, and now it's shrunk almost to only a 0.5% difference. Does it really make sense to go on an ARM if your 30-year fix is only a 0.5 point higher? That's really up to you. We see the majority. I think it's like 80% of the people who get ARMs are in a jumbo loan. And that's the reason why is because there is a big difference in payment. If you go over, let's say, $800,000 loan, you could easily see several $1,000s a year in savings over, let's say, a 7-year ARM. In that 7-year period, you're saving $30,000, $40,000 in some cases, depending on your loan amount. And if it's higher, that savings gets even more to end up at the same balance. So why would you want to spend $30,000, $40,000 more each year just to end up with the same balance over that 7-year period? So that's why those people are looking at ARMs in the jumbo categories as opposed to the conforming limits, although the principle works the same no matter what your loan amount is. Although people still don't trust banks. That's one of the stories that kind of hit the headlines, that a study came out and they basically said this is why people don't trust banks. And I'm kind of looking for it in my desk right here. But a lot of business went over from the brokerage side over to banks leading up to about 2010. And then around 2010 up till about 2016, people started pulling away from banks and going back to brokers purely based on the trust issue. They're very suspicious of some of the activities. The banks kind of got together. There were some policies made. Some lawmakers came together, and they were offering things like the HARP, Home Affordable Refinance Program. And out of the, let's just say, the 100% of people who qualified for this, only 51% of the people took advantage of this, with an average savings of $9,000. And they surveyed these people, and they said, we just don't trust banks. They were even giving coupons saying that if we didn't close within 30 days, we'll give you $500. And these were banks that were doing that, yet people still weren't going to banks. So banks weren't trusted and are not trusted now, and brokers are getting a lot of the business. And we talked about this last week, how a lot of these wholesale lenders, the lenders that you probably never even heard the names of, are filling in all of the products. We have a Bankbuster loan, a Bankbuster, jumbo Bankbuster loan. It's a loan that's designed purely to beat banks' rates. And banks for the longest time were very heavily competing on the jumbo loans. Of course, they were setting really high credit scores and high, low loan to values, meaning more equity, bigger down payments. You can't have any issues with your credit. You have to have like a lot of trade lines and things like that. But these lenders are coming back and saying, not only are we going to beat your rates, we're not even going to charge you mortgage insurance. You can put 10% down up to $1.5 million, and we're not going to charge you mortgage insurance. We can even have products where you can be out of a foreclosure in less than 7 years, or a bankruptcy, or a short sale, things like that. So because we see this part of the industry really picking up the wholesale side, brokers are really starting to take a lot of the business. We're well over 50% now, and I expect that to grow. And I think a lot of banks are going to close their doors on mortgages. I really do think that's something that we're leaning towards, and I don't have a problem with it. We're in the brokerage business. Yet I just got a phone call from an old agent. He's like, "Hey, we want to do a referral. I want to do a referral. I'm going to go for Wells." I have no problem with that. It's a great entry point, I believe, to get into the business and figure out what it's all about. But eventually, a lot of those experienced loan agents realize that they're not getting their cut of the pie, the piece of the pie. They want to come over to brokers because you can negotiate what you want. So there's higher quality people are coming towards the brokerage side as opposed to the bank side. Anyways, with that said, that's kind of my early rant in the show. We do have a good guest coming on in the second half, Tony Bruno. We haven't had him on for a long time. I hope he gets a chance to give us a call. He's going to give us an update on the East Bay real real estate market and what's going on in like places like Fremont, Milpitas, Newark, Hayward, and Pleasanton, places that he's an expert in. And a lot of people are moving that have been renting in the peninsula are moving out to buy houses in the East Bay, and this will hopefully give people a good idea of what's going on, because there's some mixed news that I've been getting from him over the last couple of days we've been talking. But with that said, you can call the show 800-516-1220, 800-516-1220, and go to our website, BayAreaLoanSource.com. That's BayAreaLoanSource.com. I found this pretty interesting here, and anyone want to make a guess on this? How many trees can be saved if the mortgage industry was to go fully digital? Now, there's several states that actually do this, including, let's see, Washington, D.C., Tennessee, Maryland, Minnesota, Pennsylvania, Illinois, Virginia, and Texas. And they can go, depending on who you use, can go completely digital. If the whole industry was to go digital, and that's about 6 million homes a year, last year, of those, 4.8 million had a mortgage. To make it simple, we're going to limit it to just the properties that had mortgages, although there is a lot of paper that goes involved with homes that are bought free and clear. And there's about 200 pages on average, according to Redfin. And if you were to take those mortgages and add it all up, it's about 8,000 sheets of paper. That means about 220,000 trees would be saved. That's about 100 trees per acre, or 1,200 acres a year would be saved if we went digital. I think it's a no-brainer, right? Not only that, it saves time. It's a lot easier. I think a lot of people who have done transactions recently have realized that a lot of these electronic disclosures that they're getting, they're like, what do we do now? I said, just open that email and sign. Just click a button for a few times. Make sure you read it. Read the homeowner's guide, and then read your loan estimate, and that's how you start it. And they don't have to fax stuff back or scan it. And we're getting a lot easier on the electronic verifications of employment and pay and W-2s and things like. Obviously, there's some situations like if you have rental properties or if you're self-employed or commission, things like that. There's other paperwork that need to be that kind of overrides that need for that simplicity of a electronic verification, but it's getting a lot easier, and I'd love to see it go completely electronic. The notaries too, they're doing face-to-face. I did a story several weeks ago about face-to-face notaries. I'd like to see that happen too. I think you log in, they do a little, you have to obviously have some way to communicate, and you just, show them your license, they write everything down, you do an electronic signature, and you're done. Beautiful stuff. And we embrace that in the industry, and we hope it keeps moving forward. And we are hopefully, I'd like to say, in front of all of the new technology. We strive to be very easygoing for clients. You're always welcome to see what we do. You can go to BayAreaLoanSource.com. That's BayAreaLoanSource.com. Hopefully we have a guest when we come back after this break. Tony Bruno from the East Bay. He's with Coldwell Banker. Been in the business like 30 years in the same city. Like, you can't ask for a better kind of realtor. We work with several realtors like that throughout the Bay. Tony's one of the better ones. We hope to have you here listening to. Again, you can go to our website for the podcasts. If you can't catch the whole show, that's BayAreaLoanSource.com, BayAreaLoanSource.com. We'll come back again after this break with our great guest. We have some emails later. I want to talk about a very interesting tax scenario that somebody called us about. Ingenious, I believe. Ingenious. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. Gordon is out. We'll be right back.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. Gordon M. Hines, M standing for missing, of course. He is out today. He's on a boat. Like, if I went on a cruise, I honestly don't think I could do a cruise that didn't stop places, because I think in the first day I'd do everything on the boat. Speaking of taking cruises, somebody who I know who always wears some sort of Aloha shirt, Tony Bruno from Coldwell Banker. How are you today?
Hey, Tony. How are you?
I'm doing well. You ever go on cruises?
I did one probably 20 years ago, and that was enough for me.
I heard I've taken cruises before, but nothing really fancy. But some of these are fantastic. I mean, you get on the boat, and like I said, I don't know if I would get on a cruise that wouldn't stop at several different destinations, because I think I would do everything on the boat in the first day or two. And the rest of the time I'd either be at a casino or at the bar. I have no idea. So,
There you go.
Anyways, Tony Bruno, you've been in the business for 30 years plus. I think you told me one of the greatest stories, or a great story. It's not the greatest one, in a long time. And that is one of the first client that you ever worked with 30 years ago came back to you just recently as listing their house. That's a fantastic story.
I can tell you where I met them 30 years ago. I met them at a condominium in Fremont on Glen Street. It was a high school buddy of mine who owned that. Nice young couple comes in, Mark and Christy, before they were married, and they were looking at condos. They didn't buy that one, but I did sell them one down in Warm Springs. And over the past number of years, they purchased 3 homes through me. And now they're retiring, and we put their house on the market 2 weeks ago down in the South Fremont Hills. And went on the market Thursday, and the following Tuesday it went pending with multiple offers.
That's an interesting part of the industry that a lot of people don't really appreciate, and that is a realtor that's been in the business a long time. You can always kind of count on them being there. I enjoy the fact that I've had the same phone number and the same email address and website for the last 15 years. And at any point in time, hey, is this Tony? I was like, yeah, I haven't changed anything. But you must get, I mean, you build up a business and it keeps flowing because obviously you do a good job and you know the area, and then eventually you can go to a prospective buyer and you're showing them houses. You go, I sold that house and I sold that house right there. I lived in that house right there, and I appreciate that out of a realtor.
I love selling in my hometown. I absolutely love selling in Fremont and the surrounding areas. It's and I share my stories because I've been here since day one, all 60 years right here in town, and I just tell them, hey, this is how it was 60 years ago, and here's how it is today. Still a great community, but it's evolved tremendously over the past 60 years.
It's one of the hottest cities in the Bay right now. It seems like every person that I talk to that's looking for something in Fremont, it's over $1 million, unless it's a condo.
Yeah, well, actually, I will tell you, our market has settled down a little bit, and we are seeing some softening in the prices. So to say everything's at $1 million, even for the houses, that's not the case. So. Yeah, the market has, as I'm sure everyone else has heard, has corrected a little bit, but it is picking up steam again. So I don't know. I wish I could judge what was going on.
A couple of years ago, we talked about how, we would do like kind of monthly reports, and you gave us a report that says, hey, inventory is really picking up going into the spring. Do you feel a little bit, but it never really did. Okay. And then the same thing happened the next year. And what about this year? How's that inventory pick up? Because there's a lot of people that are looking for options now.
A lot more inventory this year. We had a lot of leftover properties from last year. Typically, people take their homes off the market between Thanksgiving and Christmas, and they'll put them back on. But this year they didn't. And we wound up starting the year with about 120 homes for sale in Fremont. Last year we had about 60. So inventory, it's built, but it's still relatively low for the size of the city of Fremont. Of course, there's a ton of new construction going on, too. A ton.
Yeah, I've seen that. When I go down there on, for the radio show, I see the radio show's out of Fremont, obviously, and I see a lot of land that's being built on. And there's other land that can be built on, but it doesn't seem to still affect the home prices that more inventory can be dumped in the market at any point in time. To me, that is, builders going, okay, we're going to kind of slowly tick this out. There's a little bit of red tape that, can we afford this? Can we get the right materials at the right cost and the labor, and get through all the preliminary stuff that we need to do to get the permits and so on. And I think we're going to continue seeing a place like Fremont boom. It's such a perfect location for the Bay.
Oh yeah,
San Francisco's a little hard to get to, and I know that I've heard a lot of people talk about BART from Fremont. Isn't that bad because they're the first stop, right? And you get a seat. Well, if you get a seat on BART, it's fantastic.
They extended the BART down to the Warm Springs area, Fremont, South Fremont, and I'm not sure, you probably don't go that far because you're coming in from Alameda, I believe, and you just stop right there on Stevenson.
Tony, stick with us. We'll be right back.
All right.
Okay. All right. We'll be right back after this message.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. Gordon is out of town today. I think it's his anniversary. He's on a boat somewhere, wearing a nice Hawaiian shirt or something like that. Speaking of Hawaiian shirts, we have Tony Bruno from Coldwell Banker on. He's been in the real estate business for about 30 years in Fremont, East Bay. Do everything from Hayward, Milpitas, Fremont, and Pleasanton, everything.
Yep.
Thanks for being with us. I was reading this report. 1 in 8 Redfin offers faced competition in January. That's down more than a half from a year earlier. So we're seeing a lot less competition. Is that translating to here in the Bay Area? Now, you just told us last segment, real quick, that you have twice as much inventory as you did last year. Are we seeing are we seeing the less competition? Are we seeing sellers giving a little bit more breaks on their, more concessions? Tell us a little bit about what's going on.
In my experience, I've had about 6 listings come on the market from December through the past couple of weeks. The ones on December, I had to reduce them when we hit January because we had nothing coming in on them. So we reduced them, in one case, $50,000, and we had a multiple offer situation, and it went up $30,000. On a property in Livermore, we dropped to 10, and they still came in a little bit under, but the seller got what he needed to move on to his next property. But going back to like October, November timeframes, I was getting properties significantly under the listed price. But now we're starting to see it's kind of firming up a little bit. I had a listing just 2 doors down from my house, put it out at $825, and it sold for $850. And the other, my very first client, we went out a little over $2 million, and it went up to another benchmark. So we are still seeing multiple offers just starting this year. But
of course, we always say to be prepared to go into an offer and compete against other people and be well prepared with your good pre-approval letter and other supporting documents, like maybe even a motivation letter, or even we've had more people ask for sellers ask for bank statements. Where's your down payment coming from? We've even had realtors say, "Where's your DU?" Not a lot of people know what that means, but it's an automated decision that comes from the lender. A lot of people are asking for that stuff. So we still see it. It's still competitive. But what I've been trying to say over the several months as we've seen more and more inventory hit the market from last summer, especially a place like Seattle, it's more opportunities and more choices for borrowers or buyers out there. And I think that's probably the most important part. But do you remember when I talked to you about 3 years ago and I said, what do you think about these people who are just buying anything they can get their hands on? Are they sacrificing the house and location? Do you feel that same thing today?
They are being a little more selective. They're not going to buy the things back to the train tracks or back to the freeways. So they are definitely buying more selectively, and they can't because they have choices.
Do you think that the people that are in those homes, knowing that are more selective buyers coming out there, should start listing their properties while they can?
If they've only been there 3 years, probably not. Matter of fact, my son is trying to sell his house in Roseville. He's not been there quite 3 years yet. And my recommendation, no matter when you buy, minimum 5 years. Actually, I like 7 years, 7 to 10 years before you trade up. Just because you have little hiccups in the market.
Yeah, I like the fact that there's a lot more choices for buyers. And if you're a buyer and you're looking for choices and you're looking for convenience, you look at a city like Fremont, and of course, Tony Bruno, you can always reach Tony at TonyBruno.com, TonyBruno.com. He's been in the business for 30 years plus. He won't do you wrong in Fremont and any of the East Bay cities that he works in. Is that if you're a buyer, there's opportunities to, I don't want to say negotiate, but you have more choices. And when I was buying a house, I looked at 30 houses on my first house. I had choices, and I eventually ended up finding the right house. And I think that's what this market is lending to us now. Thank you very much, Tony, for being on the air with us. We'll have you back soon. Again, you can reach Tony at TonyBruno.com, a very easy website, TonyBruno.com, or you can email me, Tony at BayAreaLoanSource.com, Tony at BayAreaLoanSource.com. I'd be glad to share the information if anybody out there wants it. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez, and this is the Real Estate Report.
Phone lines are open on The Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez. Gordon is out today, but you can always call the show, 800-516-1220. You can email the show, Tony@BayAreaLoanSource.com. That's Tony@BayAreaLoanSource.com. We try to get as many emails on the air as possible. We're running into a lot of scenarios, a lot of jumbo scenarios. One in particular that we got from Ramesh, I hope I'm pronouncing that correctly. He's looking to buy a $1.2 million house in the East Bay. He has 15% down. Now, in the past, 15% down on a jumbo loan, which this equates out to, would be... You'd have to be creative. You might have to go what they call non-qualified mortgage, but a lot of these lenders have really stepped up to offer these products up to, in some cases, for a while there, we had up to 5% down. 5% down on a $2 million. I think they went to $2.5 million. Yeah, you sacrifice rate, but there's no mortgage insurance. And it's really where the jumbos figured it out. So he continues to say that he's been told that he can get a first and second loan instead of a jumbo. This is more appealing to me because I can pay off the second loan in a shorter period of time, like 2 to 3 years, leaving just the original first. It helps without having to refinance later. What are your pros and cons for this? So first, like I said, the jumbo market is full of these nice, juicy 10% down jumbo products with no mortgage insurance, and the rates are very competitive, especially considering that you don't have that mortgage insurance, because that equates out to about 1% of rate. So in essence, if you're getting a 5% rate without mortgage insurance, it's like a rate of 4% with mortgage insurance. So what Ramesh is talking about is the two loan scenario. We get a first loan. In this case, he can get what they call a conforming loan, so he can, up to $726,000 in the immediate Bay Area counties. And then he gets the remainder in a second loan. Yes, the rate's going to be higher for the second loan, but if he can pay that off sooner, does that make sense? Because immediately he gets the savings as he can contribute large principal payments as opposed to just the regular payment. And that'll knock down his payment on a monthly basis. So eventually he'll pay this off in 2 to 3 years and effectively cut that interest rate down significantly. I like this strategy if indeed you are able, and I hate sounding like a financial planner because I'm not, but are you sacrificing your retirement to pay down your mortgage? We don't really promote that strategy. We obviously like you to do both, and if you have to do one, do your retirement first. But if you can, this is I believe a great strategy. You end up with a nice fixed loan that at a rate that's competitive to the jumbo, that's lower than the jumbo loan in most cases, and you avoid the mortgage insurance. So I have no problem with this, leaving himself with a nice first loan. We like these kind of strategies, but on the flip side of this, going with the jumbo, there are so many options right now for people putting 10% down, 15% down, anything less than 20% down to 10% down. The jumbo rates are very competitive, like we said. Although this is not the rates for jumbos, the Freddie Mac weekly survey has the 30-year fixed conforming loans at 4.35%. That's at a one-year low. And why not take advantage of this? We're seeing the refinance market really pick up. Be careful of what they call serial refinancing. And usually you get the promotions from your current lender or your current broker. And serial refinancing is illegal for lenders and brokers to do that. And there is what they call a benefit to borrower rule that they must follow. And it has to do with, the savings that you get on a monthly basis and you divide that into the cost, and it has to be below a certain amount of months and things like below. So you have this calculation, and just be careful. Even if you qualify for the benefit to borrower rule, doesn't necessarily mean you're going to refinance. These are some of the scenarios I truly enjoy. I've turned away mortgages that other people wouldn't have. I've actually had people say, well, you're not going to give me a mortgage? You're recommending me not getting one? And then find out later that he did one anyways, when he or she really should not have. So I enjoy that kind of communication that I have with my clients. It does pay back in the long term, and I hope that you really find somebody that can be as honest with you as possible. Tax time is right around the corner. By the way, you can call the show 800-516-1220, 800-516-1220, or email me at Tony@BayAreaLoanSource.com. That's Tony@BayAreaLoanSource.com. So we are close to the tax deadline. This is a scenario that kind of sparked my curiosity, and it was based on a real phone call from an old client He's talking about some of the new tax laws. Standard deductions have changed. It's making it less attractive for him. In fact, it's not beneficial at all for him to itemize. That's where you do your interest deduction on your primary mortgage. So what he suggested and proposed is that he has a rental property that's free and clear. And what he would do is cash out of the rental property, okay, and then pay off his current mortgage on his primary. That way now he can get the write-off on the rental property on his Schedule E. That's going to offset the income. So he's accomplishing a couple things. One, he eliminates the income taxes that he usually would be paying on that rental income. Two, he has somebody else paying down the mortgage for him. And three, he may actually have a loss once you add in depreciation that can lower his AGI. I think this is incredible awareness of the owner, and I think that this is something that obviously you want to talk to your CPA about. But I'm wondering how many people are in this situation that should be doing something like this with the new tax laws coming up. Because, I mean, there's no denying it. We're already seeing you're getting, on average, the American is getting 8% lower in their refund. I am not looking forward to doing my taxes. I always do mine kind of late. But I'm not looking forward to not being able to write off some of the things that I usually do. And it stinks. And this is the creativeness of getting, of a person who's just really proactive in engaging his taxes. So if you have any questions about that, I would not mind talking to anybody about that. In the meantime, like I said, it's near tax time. We always want to remind people at this time of the year that if you are self-employed or you own rental properties, especially if you're going to do a transaction in the next couple of years, we want to take this opportunity to tell you to look at your taxes and look at what you're actually going to net as opposed to gross. Schedule E income and Schedule self-employed income is net, not gross. So if you're grossing $100,000 a year, but you write off 40, you're making 60, and that's what lenders look at. And what happens, you end up having to use an alternative product like a bank statement product with higher rates. That's the sacrifice you want to make. We again encourage people to contact us. We can look at your 2-year history, or we can help you plan a 2-year future history of income. Yes, you might pay some more taxes, but in a lot of cases, you might be wanting to do a transaction, and this is what we can help you do. If you want to email me, Tony@BayAreaLoanSource.com. That's Tony@BayAreaLoanSource.com. We'll come back after this break. A couple more things to talk about, and then we'll let you go and do your thing. Get ready for the weekend. We'll come back after this break. I'm Tony Mendez, the Real Estate Report on AM 1220 KDOW. We'll be right back.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. California existing homes in January. Home sales fall to the lowest levels in more than 10 years. Very interesting. Inventory is still low in January for the Bay Area. But still, it's on the rise. Places like San Jose, we saw like about 100% or a little bit over 100% increase year over year of inventory. We heard just earlier from Tony Bruno that Fremont, they see about 100% increase in inventory. So inventory. When you add that together with home prices that are affordable around the nation, that it leads to a lot more people being able to buy houses. However, there's always a flip side to every silver lining, and there's a study that came out from the National Association of Home Builders, and it said that there's been a steady erosion in the percentage of adults who said they plan to purchase a home within the next year. And that share slipped from 24% in the fourth quarter of 2017 to 13% in both the third and fourth quarter. So only 13% of adults say they would plan on buying a home in the next year. In the fourth quarter of 2017, 60% were first-time home buyers. In the fourth quarter of 2018, that slipped to 53%. So seeing less first-time home buyers. The intention to buy is inversely related to age. 22% of millennials plan to purchase within the next year, but only 14% of Gen Xers, 7% of baby boomers, and 4% of seniors. So, the report goes on and on and on. I don't think any of this really adds up until, I want to say after the summer. I think we need to see like a year of reports like this. And I mean, this is just kind of leading indicators of what we might expect throughout the summer. I still think we're going to see more inventory. I think we're going to see, contrary to what, and I don't do this that often, contrary to what Tony Bruno said earlier, I think there are a lot of sellers who are going to take advantage of the market the way it is right now. And that there are still a lot of buyers, and I'm talking in the Bay Area, a lot of owners out there that are going to sell their properties that are not so desirable. And I think we've actually been seeing this, and that's why places like the Peninsula, we were seeing homes that were, people want to buy near the beach or they want a view. And the homes, there were several homes that were on the market that were like that, and the people and our buyers were skipping over them, and they would wait. This because they said, well, another one just came on the market, and I'm going to go see this one. And they would go in a contract, and then they would cancel the contract because another one hit the market. I think we're going to see a lot more people trying to take advantage. I don't see it kind of snowballing because, again, we're looking at things like low delinquencies on mortgages right now, low foreclosure. I mean, we're like at 18-year low on delinquencies. These are great statistics, meaning that people want to stay in their houses. Couple that with low unemployment. Couple that with people who have bought or refinanced or bought and then refinanced are sitting at low interest rates. In some cases, the lowest interest rates we'll ever going to see. I did a 3.25% 30-year fixed. I haven't heard from this guy. I don't think I'll ever hear from this guy again unless he buys another house. And then he may never buy another house because he's got 3.25% on his interest rate. And why would he want to get rid of that? Exactly. Who is that? Who says that? Anyways, it's not JJ, is it?
I forget.
Yeah. Anyways, but with that said, I think this will be a more interesting year than it was last year, and more interesting than it was the prior year, 2017. I think 2019 does lend to more opportunities and more options, more choices for buyers. I encourage you to get pre-approved. We do that for you. You can always email me, Tony@BayAreaLoanSource.com. But if you are going to look at a house, get pre-approved. Make sure it's not some shoddy pre-approval. Make sure it's not some guy on the phone just saying, hey, how much do you make? What do you think your credit score is? And then I'll write you a pre-approval. You really want them to go the next steps because the sellers are still actively looking at good approvals, good documentation that comes along with it, and we want to prepare you for that. We'll come back next week. I appreciate you guys listening. Gordon was out today, and I like that sometimes. You can always reach us at BayAreaLoanSource.com. We'll come back next week. I'm Tony Mendez. This is a Real Estate Report on AM 1220 KDOW.